Welcome to today's Explainer. I am absolutely thrilled to guide you through this, because our goal today is to demystify the select few financial titans that completely dominate the world's fastest-growing major economy. We're looking at the true foundational pillars of India's financial system. And by the time we wrap up, you'll see exactly how a nation of over 1 billion people places its absolute trust and its capital in the hands of just 3 banking behemoths.
Okay, let's dive into this. Here is our roadmap for today. 1. Too big to fail. 2. SBI, the historic giant. 3. HDFC, the private behemoth. 4. ICICI, the digital innovator. And 5. The future of banking.
All right, Section 1, Too Big to Fail, Systemic Survival.
So, to truly understand these institutions, we first have to look at how regulators actually view absolute market dominance. What does it mean when a bank is officially labeled too big to fail? We hear this phrase tossed around in financial news all the time, especially since 2008, right? But the stakes here for the global and Indian financial systems are incredibly specific.
Here's the exact answer. The Reserve Bank of India actually has an official classification for these essential pillars of the economy. They're known as Domestic Systemically Important Banks, or DSIBs. If you look at this definition, it really comes down to 3 things: sheer size, cross-jurisdictional reach, and deep interconnectedness. Basically, if a bank with this label were to collapse, it wouldn't just be a bad day for Wall Street or Wall Street, it would severely disrupt the entire national and potentially global economy. I mean, they are the literal bedrock.
And who actually makes up this exclusive list in India? Well, the Reserve Bank of India officially identifies just 3 banks as DSIBs: State Bank of India, HDFC Bank, and ICICI Bank. This triad basically forms the core of our comparative case study today. So let's explore how each one earned its spot on this critical list, starting with the oldest.
Section 2, SBI, the historic giant, the public sector titan. We are kicking things off with an institution whose history is deeply, deeply intertwined with India itself. You can trace SBI's origins all the way back to 1806 with the founding of the Bank of Calcutta. Fast forward through the amalgamation into the Imperial Bank of India in 1921, until finally in 1955 the government took control and rebranded it as the State Bank of India. Today, it stands as a statutory body with a 55.52% government stake. It's the oldest commercial bank in the Indian subcontinent, surviving and adapting through literal centuries of change. And this brilliantly illustrates just how deep its roots go.
And, all that adaptation has led to this staggering number. As of July 2026, SBI serves 530 million customers. I really just want that to sink in for a second. To put that into perspective, their customer base alone is considerably larger than the entire population of the European Union. Managing that level of consumer trust at that kind of scale is just a monumental logistical and financial feat.
So, what does that look like practically? Well, visually, SBI commands a massive 23% of the entire Indian market share by assets and holds a full quarter of all the nation's loans and deposits. Servicing that requires a massive physical footprint of over 23,270 branches, and this sheer scale translates into immense financial gravity. Look at their 2026 performance. SBI posted a net profit of 80,032 crore rupees with a return on equity of 17.2%. Out in the broader market, their stock commands significant Nifty 50 weightage and trades at a very closely watched P/E ratio.
But hey, don't let the 200-plus-year legacy fool you into thinking they're stuck in the past. Despite being this historic giant, SBI remains aggressively competitive today. They've pushed incredibly hard into the digital age with their digital banking-cum-shopping platform, YONO, and they're also leveraging highly profitable non-banking subsidiaries like SBI Life Insurance and SBI Cards. They are pretty much a universal financial one-stop shop.
Section 3. HDFC, the private behemoth. Historic mergers.
Shifting gears over to the private sector, we're looking at an institution that recently completely rewrote corporate history. HDFC Bank actually started out as a subsidiary, but they grew so powerful, they ended up executing a historic takeover of their own parent company, the Housing Development Finance Corporation. I mean, wow. This mega merger centralized an unprecedented amount of commercial, retail, and insurance power under one single roof, instantly creating an empire with over 173,000 employees.
Now, what's really interesting about this slide is the sheer velocity of the capital flowing through this newly merged entity. We're talking about 2026 revenues hitting 4.95 lakh crore rupees. That's 51 billion US dollars. Their net income sits at a staggering $7.9 billion, and their total assets have ballooned to $510 billion. These aren't just big numbers on a page. They're the exact mathematical reason HDFC is systemically vital to the nation's stability.
Translating all that financial power directly to the stock market, as of April 2026, HDFC boasts a market capitalization of $137.15 billion. This valuation solidly secures HDFC as the third largest company on the Indian stock exchanges. It is a true behemoth that investors and regulators alike watch very, very closely.
Section 4. ICICI, the digital innovator. Advanced tech banking. Our third and final D side has really distinguished itself by building a completely different digital-first footprint. ICICI has deployed what they call the ICICI Stack digital ecosystem. It's this tech-forward strategy designed for a generation that, frankly, rarely wants to step foot inside a physical branch. Step 1 allows for instant digital account opening. Step 2 seamlessly integrates deposits and their iFinance personal management tools. And Step 3 unlocks over 400 services directly through their iMobile app. This lets customers do everything from paying bills via UPI to managing their mutual funds literally all from their phone.
So the crucial takeaway here is how this digital efficiency directly impacts the bottom line. Streamlining operations digitally translates to robust financial momentum. We see profit after tax moving from 47,227 crore rupees in FY 2025 to over 50,147 crore rupees in FY 2026. That is a highly impressive 6.2% year-on-year growth, proving for sure that their tech investments are paying massive dividends.
And their ecosystem extends way beyond just moving money around. They are deeply embedded in providing an essential safety net for the country. In FY 2026 alone, their insurance arm, ICICI Lombard, covered 57.6 million lives. And staying true to their innovator identity, this massive customer service operation is heavily supported by AI chatbots, Telegram, and seamless WhatsApp integrations.
Section 5. The future of banking. The big picture.
Pulling back to bring all these distinct threads together for a minute. On one side, we have the public sector anchor, SBI, with its unmatched, sprawling scale, its 23,000-plus branches, and a legacy stretching over 200 years. Then, on the other side, we have the private sector heavyweights, HDFC and ICICI, bringing immense market capitalization, ruthless corporate efficiency, and rapid digital agility to the table. While uniquely different in their approaches, these three entities collectively hold the foundation of the Indian economy securely in place. They are, without a doubt, the triad of power.
Which leaves us with this final thought for today's explainer. As these three titans continue to accelerate their growth, capturing more customers and more capital, what happens when a single bank inevitably becomes financially larger than the economy of an entire country? It's a fascinating, maybe even slightly terrifying prospect for global regulators, and definitely something to ponder as we watch the future of global finance unfold. Thank you so much for learning with me today, and keep your curiosity sharp.